Hello, and good evening to everybody. I'm sure we're all having a good weekend and excited to be back on day 3. It appears people are getting tired. I think it looks like we have a slow start. There are just 11 of us on the call right now. So we just wait for some few minutes. 7:05, we'll start as usual. I'm just taking this moment to just wait for one or two late journals. Okay, maybe while we're waiting, let me just ask one or two questions from people. Do we have anybody that you've attended this training? This is your third section. You've not missed any. Do we have how many people? If you know you've attended this section, you've not missed any of the section. Can you just put in the comments in the chat box and just say yes? Or do 3/3. Okay, fantastic. 2/3. See. Oh, okay. You watch the recorded version. NECA watch the recorded version. That's nice. I mean, we have recorded it and we have posted it on our social media channel so that I mean people can benefit. We are we are not keeping the knowledge to ourselves and sharing it with our community and hoping that others will benefit. That's the whole idea. That's the whole spirit. Okay, it's 5 minutes after 7, and in our usual tradition, we are always keeping to time. We want to always keep to time. So I want to welcome every one of us to this section today. This is the day 3 of our 2025 IFRS Refresher Course, and I believe that we've all been gaining one thing or the other. Today, for me, is one of the very interesting section, and by the time I tell you the topic we will cover, you understand, it's one of my favorite standards we are dealing with today. Just to remind us, this training is being provided by PML Professional Services and is a free training section. And like I've always been telling us at the various sections, I mean, this is usually our internal training, but we've just decided to open it up, not to limit to the personnel of the firm, but to allow outsiders to benefit. We are running for 3 weekends. This is the third weekend in the series. We've had the first weekend on 1st February, the second one last weekend, which was 8th of February, and today, 15th of February, we are holding the third one. And next week will be the final and the grand finale of the section. Well, I believe we've all been benefiting. I know that the feedback has been good. We've gotten several feedback, including people that have watched the videos after the training section. So we are very happy we're able to do this for our community. Even while I think it appears that maybe people are getting tired, well, when it comes to issue of IFRS, never you'll be tired. IFRS is a marathon. You don't learn it in one day. It's something you continue to learn and read. Even some of us, after all the years of doing it, will still continue to read it. That's what makes it IFRS. Yeah, I can bet it with you. In fact, those of us that were consultants, auditors, there are some part of the sections that we've not even implemented. There are some part of the section that you only hear about it, that somebody applied it, and that's how big IFRS is. But what is important is that you know the standard, at least you have an idea they exist, so that in case you run to those issues, you know what you can do, or you can easily go back to the standard to read about them. One of those such standards I know also not very common is things like share-based payments. I'm not sure of how many accountants have seen share-based payment, IFRS 2, in life, and even talk less of applying it. But as consultants, we see a lot from our various clients. So this section, this training is being facilitated by myself, Abiola Fajimi. I'm the managing partner for PML Professional Services, and Babatunde Abimbola, our senior manager, audit, also is co-facilitating it for me. So I thank all of you. Just to tell you, PML Professional Services, we're actually an accounting firm, and we provide audit, tax, advisory, and software services to our clients. Our clients are mainly medium-sized companies, and we've existed for the last 12 years. So if you need anything that has to do with audit, tax, advisory, or specialized software, which is your accounting solution, your GLC solutions, you can always reach out to us. So like I've mentioned, my name is Abiola Fajimi, and in terms of experience, I have over 20 years experience, and I've spent over 17 years doing IFRS, implementing IFRS for numerous organizations in the Nigerian market, and I've trained so many organizations also on IFRS. And I've been privileged to work or do IFRS projects not only within Nigeria, even in other jurisdictions where they've adopted IFRS, supporting them to implement the requirement of IFRS. In terms of qualification, I'm a chartered accountant and a member of CITN and also a certified information system auditor. Today is really my section, day 3, and I will be facilitating this section alone. Babatunde is on the call, but these 3 topics are my specialty, and I'm excited to take us on the journey of understanding financial instrument. Financial instrument is one of the very complex standards, and it's not just about the accounting. The requirement goes beyond accounting, and that's one of the things that makes it interesting. Just a moment, please. Apologies. Okay, so I'll be taking us on financial instruments, IFRS 9, IFRS 7, and IFRS 13, fair value measurement. These are major standards, especially for financial services industry, and requires not just accounting skills, but requires some good knowledge of treasury, risk management for you to be able to apply the standard. So IFRS 9, financial instruments. IFRS 9 was a standard developed by both IASB and FASB, and the work started as far back as 2009 until January 1st, 2018, when it became effective. It was a long project and was one of the major projects that was undertaken by FASB. FASB is Financial Accounting Standard Board, which is American equivalent of IASB. They actually did the project together until there was some little fallout when FASB pulled out of the project because they could not agree on certain requirements or certain requirement of the standard. So the FASB decided to pull out of that project. But that's not why we're here. We're here to talk about the IFRS 9. IFRS 9 has three major components. It deals with three major areas: classification and measurement of financial assets, classification and measurement of financial instrument, classification and measurement of financial instrument, impairment of financial assets, edge accounting. Those are three areas that are covered by IFRS 9. For the purpose of this standard, we will focus mainly on classification and measurement of financial instrument, impairment of financial assets. We will not talk so much about edge accounting because I know that most of us in Nigeria and this part of the world, we do not do edging. We do not do edge accounting. So our focus will be on what we believe is very relevant. So what is a financial instrument? Financial instrument, in a nutshell, is a contract that gives rise to financial assets in one enterprise and financial liability or equity in another enterprise. We all know that in every contract, there is at least minimum 2 parties to a contract. So when you have a contract that it will give rise to financial assets in one, so one of the party will have a financial asset, then the other party will have a financial liability or equity. That is considered as a financial instrument. So now, 2 ambiguous words have been introduced, or 3 ambiguous words. What is a financial asset? What is a financial liability? And what is an equity instrument? Because the definition just say a contract that gives rise to financial asset and financial liability or equity instrument. So let's go further down and try to understand what is financial asset. So when we talk about financial assets, we are talking about a contract that is cash. Financial asset refers to cash. Financial asset refers to cash. If you have anything that is cash, contractual right to receive cash or another financial asset from another entity. If you have a contract that the agreement is such that the other party will give you cash, you will get cash in return from that other party, or they will give you financial assets of another entity. That is also a financial asset. It can also be a contract that will or may be settled in the entity's own equity instrument. If you have a contract that the agreement is such that you will be given your equity instrument in return. Somebody has agreed that, okay, I won't give you cash, but I will give you your own shares in return. That's also considered as a financial asset. Then contractual right to exchange financial instrument with another enterprise under conditions that are potentially favorable. Part of requirements for a financial asset is that there must be a contractual right. There is an obligation that you are going to exchange financial instruments, that your financial asset will be exchanged for another financial asset. That is considered as a financial asset. Then equity instrument of another entity. If you have equity instrument of another entity, that is also considered as a financial asset. So if you think about it, can somebody tell me when you hear contract to receive cash or financial asset from another entity, that can be things like receivable. If you have a receivable in your book, you know, when you have a receivable means that there's an agreement that that third party is going to pay you cash, is going to give you cash for that your receivable at the appropriate time or when he has it. That is considered as a financial asset. So that contract is considered as a financial asset. That receivable is considered as a financial asset, and it's a good example of financial assets. If you have treasury bill in your books, in your financial statement, what you have and what that means is that there's an agreement that government is going to give you interest in form of cash, and also is going to pay back, is going to give you your principal back in the future. That's also considered as a form of financial assets. Then if you even have equity instrument of another entity, for example, you have equity instruments of a bank, you have Access Bank shares, you have GT Bank shares. The expectation is that GT Bank, your expectation, and I have to be careful here, the expectation could be that I will expect that I will get dividend from GT Bank over a period of time, and sometimes I will also end up selling that my GT Bank shares to another person on the floor of Nigeria Stock Exchange. That is also a form of financial assets. If you have bonds, loans, all of these are examples of financial assets. So if you think about your business, your organization, for those of us that will work, and think about the items that make up of our financial statement, you will then find out that considerable number of items in our books will fall into this bucket. If you have things like trade receivable, loans, bonds, treasury bills, all of these are examples of financial assets, and they have to be treated in line with the requirement of IFRS 9. Let's look at financial liability. Financial liability is the other side of the financial asset, because like I told us, financial instrument is a contract that gives rise to financial asset and financial liability. So financial liability is a contractual obligation to deliver cash or another financial asset to another enterprise. You have financial liability when you have an obligation to deliver cash. Now, remember when we're talking about financial asset, we're talking about obligation to receive cash. So for financial liability, we're talking about obligation to deliver cash or another financial asset to another enterprise. When you have that kind of obligation, we will say you have a financial liability because you have an obligation to deliver cash. If you also have an obligation that all may be settled in your own equity instrument, you are also considered to have a financial liability. When you have an obligation that you will give your shares, you will give shares in return, whether it's your own shares or the shares of another party, you also have a financial liability. And the last point in red is a very important point. The point here is that the financial instrument will be exchanged with the other enterprise under conditions that are potentially unfavorable. What makes a liability? The definition of a liability is an obligation that even when it is not unfavorable, you cannot turn it down. Because when you can say no, when the condition is not unfavorable, then it is not a liability. So there must be other agreement that even when the condition is unfavorable, you have to fulfill your obligation. Example is debt instrument. If you issue a bond, now you are the one that have issued it, not invested. Here is the case of you have issued a bond. If you have issued a bond, you have a financial liability. If you have borrowed money, you have borrowings, you have a financial liability. If you have deposits, you have financial liability. If you have deposits, you have financial liability. Like banks that take customers' deposits, those are example. That's another example of financial liability. Then equity instrument is any contract that evidence residual interest in the asset of an enterprise after deducting all of its liability. Example, ordinary shares. So if you don't have financial liability, you could also have equity instrument. And any contracts that evidence that when all the obligation of this entity is shared, when all the asset and liability of this as a company is realized, whatever is left, you are part of the beneficial owner. Such interest is considered as equity instrument. If you have anything that gives you that right, that is considered as an equity instrument. I'm not sure, is there any financial instrument that possibly I have not mentioned that anybody have as an example to give us? You can just put into the chat box. Here we are to identify such financial instruments you are familiar with. Can we do that? Is there anyone, or maybe even mention the example of equity instrument or financial instrument you know in the chat box? You can just tap into the chat box. Okay. Oh, I like this. Okay. Trade payable. Okay. Gabriel gave example of trade payable. Well, trade payable, um, the um, the issue with trade payable, especially in the line of IFRS 15, is to be careful of sales payable. I mean, your trade payable, because under IFRS 15, if you have advance sales payments, your customer has brought in cash for services that you've not provided, so you have not recognized it in your books as sales. That such trade payable, you might not be able to, you will not recognize it as financial. It won't comply with the requirement of financial instrument. It will not be a financial liability because it's an IFRS 15. It's revenue related, so you will not recognize. You will not treat in line with IFRS 9. But if it's pure trade payable, maybe it's obligation due to your vendor, obligation due to your supplier, those ones will qualify for financial instruments. They will be classified as financial liability. But if it's advanced revenue payment, no. Bills receivable, yes. PDC, what's this PDC? Okay, I'm not sure I know the meaning of this PDC. Maybe the fellow will give us the meaning. Subscriber wallet, correct. That's a good example. Share certificate, yes. Deposit for share, yes. Commercial paper. Good deliver in advance in exchange for advance cash between two parties. This happens a lot. Good deliver in advance in exchange for advance cash. Yes, that's good. Cash can be classified as other payable instead, not trade payable. Yes, and we are still together. Post-dated check. Okay, yes, post-dated checks. Thank you. Thank you. So good one. So we'll continue. Thank you. Let's talk about initial recognition, classification, and measurement of this financial instrument. And this is very important. Under IFRS 9, we need to be careful how we classify our instrument. And I will talk more about it. But first, let's talk about initial recognition. All financial assets and financial liabilities should be recognized in the statement of financial position when the entity becomes party to the contractual provision of the instrument. So under IFRS 9, immediately you become a party to a contract, you need to recognize it in the financial statement. There is nothing like I have not made cash payment or I have not parted with any obligation. This is important, especially when we do some of these very complex financial instruments, like forward contracts. In forward contract, you have not parted with any cash. Like, for example, you could have approached a bank and say, bank, I know that I will need $100 in 3 months' time. Please give me an assurance that you are going to sell me $100 in 3 months' time at this particular price. And the bank agreed. Nothing serious, for no serious financial commitment at that point. Maybe minimum they just charge you small premium for that commitment, and then you go away. But in 3 months' time, you will have to settle that obligation. Under IFRS 9, like this kind of transaction is a financial instrument, and you are expected to recognize it from day one, from beginning, so that you do not just keep such contracts in your cabinet or in your safe. No, you need to account for it. And what IFRS 9 requires is that financial assets should be recognized initially at the fair value of the consideration given. And financial liability should be recognized at the fair value of the consideration received. What do you mean by fair value? Fair value is that, and I will talk about fair value standard as the last thing. It is the layman, the consideration that you need to part way with in an arm's length transaction at that point of the transaction. What is considered to be the reasonable value of that contract at that point? There are a couple of methodology to determine that, and that's why we'll take a standard of fair value measurement itself. So you need to recognize it at the fair value on that day. Day one. Initial recognition refers to the day you actually did that transaction. Special consideration should be given to instrument not negotiated on an arm's length basis. We need to pay special attention to instruments that are not done at an arm's length basis. Because when the transaction is not done at an arm's length basis, it means that the fair value of that instrument cannot be the actual price you are paying for it. Example is interest-free loans, staff loans. Some of us work in organizations where we are giving a loan at a rate that is below the market. Such instrument is not at fair value. Such instrument is not at fair value, and you need to determine really what is the fair value of that transaction on day one. How do we do that? How do we do that? Let's look at the case of a staff loan. You work in an organization and you are given a loan of 1 million for discussion purpose at an interest rate of 5%. What is the interest rate today? Most likely 30% or maybe 35%. And you can see the gap. That's a 30% benefit that the company is quietly giving to you, which sometimes people don't even appreciate or understand that there is a benefit the company is giving to you. And sometimes it's even worth consideration when you want to take up jobs, especially when you're at a level, maybe you can take things like mortgage. Imagine if you take a mortgage of 100 million at 5%, compared to somebody that have taken a mortgage of 100 million at 35%. That's a considerable gap, maybe a gap of 25 million difference annually. So what the standard requires you to do, I will make it very complex and I will also explain it in a very simple layman language. For those of us that were very good students of corporate finance, how do we know the fair value of this 1 million that was given to you at 5% instead of 35%, what you do is that you are going to calculate your cash flow. This 1 million, I have collected it at 5%. How much am I expect? I've collected it at 5%, but if I've gone to market, I would have collected it at 35%. Based on the 5% I've collected it, how much am I expected to pay over the life of this loan? So you do the calculation. We're all familiar with that amortized cost, the loan repayment schedule that the bank normally give us. I'm not sure whether if I can find one and there's time, we might look at one. So you calculate your loan repayment based on an interest rate of 5% and say this is how much I'm expected to pay. Then you will discount it. So that money you are expected to pay, you will discount it to today's value using 35%. And we all know if you discount it using 35%, you will get an amount that is lower than 1 million. I know I'm making it complex for students of corporate finance. Yes, I will explain it in a layman language. So that value, if you discount that money you're going to get after projecting based on 5% to 35%, using 35% today, you will get an amount that is lower than 1 million. That amount is the fair value of that loan. And whatever is the differential is the benefit the organization is providing to you. But if you want to explain it in a layman, the fair value is the amount that you will give out for the company to get the same interest rate of 35%. Okay, let me explain it again. It is the amount the company is supposed to give out if they want to get that interest that they will get on that your 5% 1 million naira loan. You know, when you look at the interest you get on that 1 million, there is an amount called that amount X if you use 5%. So the company will not sit back and say, if ordinarily this man is not our staff and we want to earn the same interest, what amount do we need to give out? You find out that they will have given out a lower amount to get that same interest, X, that they are getting from you as a staff. That lower amount is the fair value, and whatever is the differential is a form of compensation. So your financial asset and liability, your financial instrument must be recognized initially at arm's length. So every of those financial instruments, you need to determine if it's at if it's at arm's length. The next one is the classification of our financial assets. How do we classify our bonds, treasury bills, placements, receivable under IFRS 9? Under IFRS 9, there are 3 categories, which is different from 4 categories that we have in IAS 9. For those of us that we are veteran in this standard, or we've been applying this standard for a while, you will remember that there were 4 categories in IAS 39. But in IFRS 9, we add 3 categories. The 3 categories that we add in IFRS 9 are financial asset at amortized cost, financial asset at fair value through other comprehensive income, and financial asset at fair value through profit or loss. These are the 3 categories. Depending on your classification, that will determine your basis of measurements. Whichever way you classify this instrument, that determines how it will be measured. When doing IFRS 9 classification, when carrying out IFRS 9 classification, it is very important to understand the business model of the entity and the intention. And that's why if you look at it, the first point here is that what is the entity's business model? Is it to hold the financial asset to collect the contractual cash flow or not? You look at the entity, the company, and say, what is their model? What do they do with this financial instrument? Do they just hold the instrument and be collecting the cash flow not just any cash flow, it's called contractual cash flow, meaning that a cash flow that is based on the set parameters of that contract, that is based on the agreed interest rate of that contract. That is the business, that is collecting financial assets, collecting cash flow as a result of the contractual terms. So you ask that question, is either is a yes or no. If it's a yes, you move to the next one. If it's a no, you go the other direction. And in the other direction, is that the entity asset had to achieve an objective by both collecting contractual cash flow and selling the financial assets. Are you holding it with intention that we will collect the contractual cash flow and we will also sell the financial instrument? If it's yes, then you go down. If it's no, you go the other way around, which is fair value through profit or loss. So if you say part of the objective is that you want to collect contractual cash flow, okay, then we need to ask the next question. Does the contractual cash flow represent sole payment of interest and principal and interest? Which I know that in Nigeria, for example, most of the instruments we have, the contractual cash flow always represents sole payment of principal and interest, which means the money I'm getting is just for the principal and my interest. That's what they are compensating me for. It is not like in some other jurisdiction, whereas your interest may be linked to some fair value changes, some index. Nigeria, we hardly have instrument that the interest is linked to markets. Most time our interests are usually contractual, so we don't have a market link or market-based variable interest. So if you say your interest is just for sole payment of, it's really for contractual cash payment, and it's for sole payment of the principal and interest, then you go to the next one. Does the company apply the fair value option to eliminate accounting mismatch? There is a part of the standard that allows us to adopt fair value option to eliminate accounting mismatch, because there are some industry that really speaking, the instrument might not qualify to be at fair value, but you can elect. So if you elect that, even while this instrument does not qualify as instrument at fair value through profit or loss, but I'm electing to do that, then you go the fair value through profit or loss option. Then if you are not making that election, then you either classify your instrument as at amortized cost or at fair value through other comprehensive income. These are brief grammar. Let me break it down in a way that we all can relate with it. Simple and not very complex. So now, if we have an instrument that you get, what you get is interest, and that's, you just expect that I will get my interest and principal, and then that will be the end of that instrument. Typically, you go the way of amortized cost. And once you know that that is your intention, I will buy this instrument, I will collect the interest repayment, I will collect the principal repayment, and then that will come to the end of that instrument. Then you can go the option of amortized cost. You are expected to go the option of amortized cost. But for us, even when we buy the instruments, we know that once we see advantages in the market, there's a fair value adjustment, we think the pricing is now very good, we will not wait to collect our principal and interest. We'll just go and sell the instrument and get our cash flow back. Such people that like to do that, such instrument should be classified as fair value through profit or loss, because your mindset is that as the price of that instrument changes in the market, you are going to sell it. Even when it's paying you interest and principal, you will go and sell it. That means that in such instrument, you should classify it as fair value through profit or loss. Then if you have the type, especially equity, and you know that this is my equity, yes, I am there, I'm holding it, I'm not taking advantage of the market, I will just hold this instrument, and I will be collecting my maybe bonus, dividend, and that's how I will realize the value in such an instrument. Then I will classify it as fair value through other comprehensive income. FWOCI. That's fair value through other comprehensive income. So by rule of thumbs, let me help us. Rule of thumbs, your interest-bearing instruments, bonds, treasury bills, the first thinking is it should be an amortized cost. But if you find out that the organization is trading on it, then you may think about, should it be classified as fair value through profit or loss? Instruments that are equity instruments that companies trade on. Rule of thumb, fair value through profit or loss, because they trade on it until they can prove to you and say, look, this instrument, we don't really trade on it. We are holding it for long term. Irrespective of what happened in the market, we'll classify it as fair value through other comprehensive income. Let me give us an example of when we use accounting mismatch. A good example. For some people, for example, if you have all these money market funds, because funds most time are unitized, meaning that the interest of each subscribers is denoted by subscriber units, and people exist from it from time to time. So in such funds, what sometimes they do is that they will put those instruments that are supposed to be at amortized cost, they will elect to state them at fair value, because people come, people go. You don't want you want the instrument to be at that fair value at any point in time, so that anybody that is joining or leaving will be leaving at the market-based pricing of that fund, not on mere amortized cost, which is like your historical cost. So you don't want that to happen. So you can elect that such instrument will be at fair value. So when they have bonds and co, they elect to put it at fair value, because they feel since the subscriber join at fair value and they exist at fair value, it is better that all the instruments are at fair value. Financial liability can be categorized into two. Financial liability at fair value through profit or loss, or financial liability at amortized cost. For us in this part of the world, most instruments we have for our financial liability at fair value is at amortized cost. We put our financial liability at amortized cost. But your financial liability, which is where you are having that liability for the purpose of trading short-term profit making, you can designate it as held for trading, which is for short-term profit making, or you elect, just like what we did for the financial assets, you can elect to designate it as financial liability at fair value through profit or loss. But typically, most financial liability in Nigeria are classified as amortized cost. Any question on this classification? Always put it in the chat room. We'll take a look at it at the appropriate time. Now let's go to the measurement. So depending on your classification, that determines your measurement. Your financial instruments are classified and measured as follows. Financial asset at fair value through profit or loss. You will always measure it, record it in your financial statement at fair value. And whatever is the fair value gain or loss goes to your profit or loss. Please don't forget. Once you say classify the instrument as fair value through profit or loss, whatever is the changes in the fair value goes to your profit or loss accounts. For financial asset at fair value, the fair value is recognized in other comprehensive income. And that your other comprehensive income is your reserve. Your equity is part of your equity, other comprehensive income. That's where you recognize financial asset at fair value through other comprehensive income. For financial asset at amortized cost, you measure it at amortized cost. Your amortized cost is essentially your principal plus interest minus repayment. Your principal plus interest minus repayment, which is similar to your regular interest, similar to our regular interest accrual and interest computation. The only difference is that that interest rate needs to be at the effective interest rate. And your effective interest rate is talking about your effective yield. When you consider the total cost, total returns you are getting on that instrument, that is your effective rate. And that's the rate you expect to use. For financial liability is at fair value. For financial liability at fair value through profit or loss, you need to measure it at fair value. and recognize the fair value changes in your P&L. For the financial liability at amortized cost, it's measured at amortized cost, and fair value measurement is not relevant. Unfortunately, we won't have enough time. I will have demonstrated some of this calculation to us, especially amortized cost. Amortized cost calculation is always a very interesting calculation to do, but you can do it for the next 30 minutes, which we don't have that kind of time. Okay, question. What is the difference between effective rate and rate of return? The two of them are exactly the same. It's just it depends on who is using it. IFRS people talk about effective interest rate. Investment or treasurer talk about rate of returns. The two of them are the same. You are measuring the same thing. Now let's go forward. Let's look at impairment under expected credit loss. So I've dealt with initial recognition, classification, and measurement of financial instruments. I want to go to impairments. Under impairments, under IFRS, we use what we call expected credit loss. Under IAS 39, we used what we call incurred loss, but IFRS 9 introduced the expected credit loss, which is the change, one major change that was introduced by IFRS 9. Impairments, which is the same thing as what some of us call provision, a bad debt provision. It's really the same concept that impairment is talking about. And impairment is recognized when there is a loss allowance for the expected credit losses on financial assets. When do we say there is a loss allowance? When you think that the value of that your financial asset will not be recovered in full by virtue of what has happened or by virtue of the development. You believe that the value of that your financial asset will not be recovered in full, then you need to recognize impairment, recognize loss allowance. But under IFRS 9, one of the things it introduced is that it is not until when you are aware, when it has happened, immediately you do that transaction, there is a presumption that there will be impairment. And because that presumption exists, immediately you should begin to recognize the expected loss, the expected credit losses in respect of that instrument. You should begin to recognize it. And all of us know, if we give, for example, for class on an understanding, if I decide to give loan to everybody in this section, I can almost bet it that not everybody will pay back. So which means from ab initio, there's an expectation that some people will default. And that's what IFRS 9 was pushing for, that expectation should be recognized immediately the instrument is recognized as an expected loss, which is clearly different from what we had under IAS 39. IAS 39 was incurred loss. In IAS 39, you don't recognize such losses until it has happened. But IFRS 9, immediately you think it exists, immediately you recognize that instrument, you need to recognize the expected credit losses. So credit losses is recognized on financial asset at amortized cost, financial asset at fair value through other comprehensive income, on your lease receivables, on your contract assets, on your loan commitments, and financial guarantee contract. On all of these, you need to recognize loss allowance, expected credit loss. When do you recognize expected credit loss? For those of us that will possibly we are familiar with some of these are old practices. You will have seen that a couple of those things we recognize impairment based on aging. We will count dates. The customer has been in default or he has not paid his obligation for the last 30 days, 90 days. So let's recognize impairment. But under IFRS 9, really the basis of recognizing impairment is largely when there is significant increase in credit risk. When there is a significant increase in credit risk, that is, when there is changes in the credit risk assessment of that instrument. When you think that the credit risk has increased from the initial recognition, from the point when you recognize it and the point when you now notice or you can conclude that there has been a significant increase in that credit risk, that is when you then need to recognize expected credit loss. It's a relative measurement because you are measuring the credit risk from time 0 to time t1, from the initial recognition to a point in time. That is when you are measuring that increase in the credit risk. And that's what is going to drive the kind of impairments you need to recognize. Also, when the instrument goes into default, and I will talk more about the definition of default, you also will need to recognize expected credit loss. In all of this, in building these parameters or making this evaluation, maturity of that organization is very important. How robust is the framework, especially the credit risk framework of that organization? A very robust environment will have all of these measurements as part of their good credit risk practices. But for a small organization, you may not get this kind of structure in place. The assessment can be done on an individual basis or on a collective basis. Individual basis meaning that you can pick a particular instrument, or collective, adding all those instruments or bundling them together to make that evaluation. To us, for those of us that were accountants already and were working at various firms, how do we monitor this migration or degradation of customer credit quality? That remains one of the big questions because a lot of people have actually not built such system to be able to monitor the migration of the customer credit qualities. How do we measure the impairments? The impairments and all of these instruments can be measured using two approaches: general approach or simplified approach. Okay, kindly explain the taxation of ECL. I will come back and explain it. Let me finish this. So you can have general approach or simplified approach. In general approach, that can be used for all financial assets subject to impairments, except for, you can use it for all financial instruments, all financial assets, except for trade receivable and contract assets. General approach is allowed for all instruments apart from trade receivable and contract assets without significant financing components. Without significant financing components. The work there is that such trade receivable and contract asset must not have significant financing components, because sometimes you have trade receivable that has a significant financing component. Once it has a significant financing component, you cannot use the general approach. You have to use the general approach, sorry. Once it has a significant financing component, you have to use the general approach. But if your trade receivable and contract asset do not have any significant financing component, you can use the simplified approach. This option of simplified approach was really brought into the standard because of the concerns of the manufacturing guys who just have mere trade receivable and nothing complex. There are concerns around having to build a very complex model, a general model, to be able to do that impairment. That's why the standard allows them to use simplified approach. And so for you to use that simplified approach, you must not contain, the trade receivable must not contain significant financing component. And I think maybe on day one, I gave an example of trade receivable that could have significant financing component. Like all those buy now and pay later. You buy the equipment, then you pay later. But there is a clause. If you buy it now, you pay 1 million. If you want to pay over 12 months, you pay 1.2 million. Technically, they are factor in financing into that contract. So such trade receivable, you cannot use simplified approach. So let's move forward and look at general approach. So when we talk about general approach, we look at this treatment in stages, and it's called staging. One of the critical requirements, the critical things you need to determine under the general approach is the staging. Determining what stage is that financial instrument. Remember earlier I talked about significant increase in credit risk. So the instrument is considered to be in stage 1 when it's performing, it's meeting all its due obligation. The interest is being paid at the appropriate time. We are receiving our interest at the appropriate time. There is no default, there is no delay. Such one, you can consider it as performing. So for it to be in performing stage 1, it must have a low credit risk, or there has not been significant increase in credit risk since initial recognition. The credit risk of that organization or of that instrument has not increased. It is still at the same level it was when you initially recognize it. No significant increase. You can classify that as stage 1. The obligation must not be more than 30 days past due. The obligation on that instrument must not have been past due more than 30 days. It must have not been outstanding for more than 30 days. If it's more than 30 days, then it can no longer be in stage 1. So if you satisfy the condition 1 and 2, then you are expected to do stage 1. And when you classify it as stage 1, you are expected to recognize impairment using what we call 12-month expected credit losses. 12-month expected credit losses. Please note it. 12-month expected credit losses is what you will use to determine the amount of impairment to recognize. And I will talk more about this. Whereas if it's in stage 2, there have been significant increase since initial recognition. You can actually see that the credit risk has increased. And the obligation is now more than 30 days past due. It has an unpaid obligation for more than 30 days, but it's less than 90 days. In that case, you will recognize what we call lifetime expected losses for underperforming facility. Lifetime expected credit losses for underperforming facility. And the interest will continue to be recognized on the gross current amount, meaning that you are not going to write down the interest, the principal. You will continue to recognize that interest on the same principal. Then stage 3 is when it's in default. Stage 3 is when the customer has defaulted, the obligation is now more than 90 days past due. Immediately the obligation is more than 90 days past due, you need to move it to stage 3. This number of days is called the backstop rule in IFRS 9 because it's just providing day guidance, just like what we have under CBN Prudential Guideline. And you'll be expected to recognize lifetime expected losses for non-performing. And it's slightly different. Remember the first stage 2, I said lifetime expected losses for underperforming, lifetime expected losses for non-performing. And your interest would need to be recognized on amortized cost. On amortized cost, because you will need to write down the loan or the financial asset by the amount of impairment to arrive at the new balance. And the interest will now be recognized based on that new balance. How do you recognize the 12-month expected credit loss? In fact, how do you recognize expected credit loss? Expected credit loss recognition is similar to the Basel model. For those of us that were familiar with banking, Basel model on the recognition of expected credit loss. In fact, it's a Basel model that's adopted. And in recognizing the expected credit loss, there are three parameters that are considered. You consider one, exposure at default, EAD, probability of default, and loss given default. So if you want to do the 12-month expected credit loss, which is for stage one, if you are following, for stage one, you are going to need to use probability of default for 12 months probability of default, which means it's probability of default for a period of 12 months. That is what you are going to use for stage one. So you multiply the three parameters, exposure at default. Exposure at default in the layman is your balance on that instrument, the carrying amount of that instrument at the point of default, times the probability of default, 12 months, times the loss given default. I will define loss given default further. And the same way, if you want to determine the lifetime expected credit loss for underperforming, it's the same formula. The only thing that is different is the PD. The PD for lifetime expected credit loss is lifetime probability of default adjusted for the future economic forecast. So this one is a lifetime PD, whereas the other one is a 12-month PD. Probability of default arises from the probability that the borrowers and counterparty in the transaction may default. It's just the likelihood. It's a measure of the likelihood that the borrower, so your investor, the likelihood that the issuer may default or meeting up his obligation. The likelihood that there was a time that Americans were afraid that during Obama's era, the American was going to default. And I said it's not going to happen because the probability of the consequences of a nation having defaulting is so enormous, because if you default as a nation, your probability of default will increase, and it will impact on not just this nation, even businesses. So probability of default is determined by considering the likelihood that a customer may default, the likelihood that a customer or an issuer may default. That's the probability of default. And it can be determined across rating grade or sector. When you want to calculate probability of default, you can decide to do it for the organization as a whole, or you can decide that you will do it in stratas. You can do it along a sector, you can do it along an industry, you can do it along a grading scale. If it's an organization that you have grading system, you can also do it along that. And in calculating the probability of default, I mean, we are going to see some calculations. Please don't, just to bring up the subject, make it real. In calculating your probability of default, you can use three methods. Historical customer data, you can use historical data if the client has data. You can benchmark with external rating agencies, and you can combine 1 and 2. So how do we use historical data? If you want to use your historical data, you need to use a migration model. A migration model is really just studying those customers or that financial instrument, how it has deteriorated over a period of time. So if you want to do probability of default for 12 months, which is your stage one, you need to study how it has deteriorated for a period of 12 months. If you want to do it for a lifetime, you then need to study how the customer's rating has deteriorated over the lifetime of that instrument, which means you'll be studying the time T into infinity. You'll be studying how long the customer quality deteriorated. Really, the beginning of you having a good migration model is you having customer credit quality assessment, which is usually one of the challenges, because a lot of organizations in Nigeria do not do customer credit assessment. You do not assess your customer credit. But if you are the type that you do your customer rating, for example, you rate your customers, you rate your instruments, and you attach a scoring or percentage rating to their credit quality, you can easily monitor how the quality is behaving over time, how they are deteriorating. over time. You can study that. So you expect to study this for over a period of time. I'm sure for those that possibly are bankers in the room, you'll be able to relate more with this issue, because for the banks, it's very important they do credit quality assessment. They assess each customer and put a rating, and over a period of time, they continue to check the rating of those customers to see how they are doing. So to calculate your probability of default 12 months, for example, you need to study your portfolio over a period of 12 months. And I've just brought a very basic formula. I mean, if you go to literature, if you search literature, you see a lot of complex ways of deriving this probability of default. And the common one, basic one, is to just say number of customers in a loan. Maybe your own is instrument, not a loan. I've used a loan because loan is where you have the bulk of it. Most banks have loans in hundreds, if not in millions. And the simple thing you can use is number of customers in a loan classification that are deteriorated within 12 months, if you are doing 12 months PD, or lifetime over number of loan customers in the class at the beginning of the month of the 12 month or lifetime. So what does this say? This means that you can look at your portfolio. Maybe you say, okay, as at the beginning of 2024, we had 500 customers. How many of them deteriorated by the end of 2024? Which is what that numerator is talking about. Number of customers in the low classification that deteriorated in 12 months. How many of them found out that they have deteriorated over the 12-month period? Over the total number at the beginning of the year, that gives you an idea of the probability of default. How you measure deterioration can really vary depending on how robust and the kind of system you have in place. And if you want to do the probability of, if you want to do lifetime probability, then you need to study it over the life of those loans. That means you can go back to 2019 and say we have 500,000 customers. What has become of the 500 customers today, 6 years after? That gives you an idea of how they have deteriorated, and you can use that formula to derive it. Now, let me bring us a small example. Do we have calculator? Now I think it's becoming complex. Do we have, if we have, can we look at this together? So if you look at this is an example. We want to calculate the probability of default for this portfolio. We have done it over a 12 months. So at the beginning of the year, like I explained, the client or the bank had 50,000 customers. So what they have done is to just use PSDL, performance substandard, doubtful, and loss. Even while it's not a perfect representation of credit assessment, but sometimes they use it to just an abridged thing to be able to do this calculation. So P being the best, so X substandard being the next, doubtful after, and lost the worst case. They then study, okay, this is what we had at the beginning, 50,000. At the end of the year, what has become of this 50,000 loan? If you go to the P category, at the end of the year, 30,000 of them remain in performing. 5,000 deteriorated to X, substandard. 4,000 deteriorated to doubtful, and 1,000 deteriorated to loss at the end of the year. The same way for the substandard, at the end of the year, 1,000 story change, 1,000 even got better. 500 remain in the same category, 400 moved to doubtful, and 100 moved to loss. Then for the doubtful, 5,000, 3,000 came back to performing, 500 substandard, 1,200 moved to doubtful, and remaining doubtful, and 300 moved to loss. For the loss, well, none of them came back to performing, 500 moved to substandard, 200 to doubtful, and 2,300 remain as a loss. So we are required to calculate the probability of default. Now, if you look at this, one of the things that has been highlighted are actually the bucket that deteriorated. If you look at it, those highlighted cells were actually the one that deteriorated for each of these categories. So let's Let's do some exercise, and I want to throw it open to the class, to the audience. Can anybody try to calculate for P? What is the probability of default for the group P, for the classification P? They were 4,000 at the beginning, and at the end of the year, 5,000, 4,000, and 3,100 deteriorated. If you have the answer, you can put it in chat box. Okay, Daniel, Refua, 20%. Felix, 25. Mohammed, 25. Okay, okay. Chukwu Edwin, 40. Okay. Can we try for X? Let's try for the category X. Now, we'll come back. I will still tell us that we'll see the solution. Okay. If you are trying for X, please indicate, just put X equals so that we can differentiate it. Okay, 25% for X, yeah, 25% for X, 40% to your sim. Okay, let's try for D. Okay, 6% for D. Okay, interesting. Okay, I'm seeing so many wonderful answers here now. Okay, so finally, I want us to try for the whole portfolio. So what we want to do for the whole portfolio, we need to consider all the highlighted area and try it together and add it together. Does anybody have the answer for the total? Okay, 21.6, Daniel. Okay. 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 Thank you. I think this was a fair attempt from all of us. A fair attempt for all of us. So I should just well done, everybody. Nice one. Okay, so for the first one, for P, if you look at it, if you add 5,000 plus 4,000 plus 1,000, that's 10,000. So you do 10,000 over 40,000. That will give you 25%. So in interpretation, the probability of a customer in this category defaulting within a 12 month based on this data is 25%. If we're looking at X again, if we add 400 and 100 together, that's 500. 500 over 2,000, that's also 25%. The same way, 300 over 5,000, that's 6%. If you add all the yellow areas together, I also know how if you add all the yellow areas, the highlighted areas together, 10,000 plus 500, that's 10,500. 10,800. 10,800 divided by 10,800 divided by 50,000. That's 21.6. So as a portfolio, the probability of default for the portfolio is 21.6. For very good organizations that are very mature in risk management and IFRS, these are some of the things sometimes they play around, because you can decide that you can tell yourself, you can say, we want to do our probability of default along this category, or we want to do it for the portfolio together. The standard allows you. The only thing you need to make a disclosure. Remember, this is an estimate. We talk about estimate on day one. So you need to just disclose how you are analyzing your portfolio and how you are grouping it. And whatever changes you make, remember, it's an estimate and it's going forward. It's prospectively. So the answer is 21.6. How does this apply in real life? Because this is really what happened. So if you think about the commercial bank, this is how they build their probability of default. They possibly have to analyze 2 million records. This thing that we just done that looks so simple, 50,000. If you have a big portfolio, you will see that you need to do a serious data analysis, data cleansing, to be able to get to this summarized table. I do this for banks. We'll sit down analyzing the data, because it means that I will ask for the bank portfolio 2020, and I will study that same customer for 5 years, for 6 years, to understand the trend of what happened to the customer. What did it deteriorate to? We'll build it up. If it's 12 months, 12 months is relatively easy. That one is usually short. You can easily build what happened to customers over a 12 month. But when you want to do for lifetime, it's the same calculation, is only the time horizon that is different. You are going to study it over in fact, it's to an infinity. So we typically build for 6 years. So we'll pick our data and study it for 6 years, because we'll say reasonably 6 years is long enough to study what will happen to a customer over a period of over his lifetime. And that's how you build it and do the calculation. I see some questions. Let me pause and look at the question. Okay, sorry, it is 100, not 1,000. Okay, maybe I made one wrong statement. Question should be the 3,000 on L, not be a 100% position, just thinking about it. So from okay, somebody is asking question about the L. Because L is already in the worst case. It's already, if you look at this, okay, I didn't tell us. Maybe let me provide a bit more clarity, more information. Your L is considered as a stage 3 because it's already in a non-performing category. So it cannot deteriorate further. It cannot be worse. It's already in the worst case. So when you want to measure if there is a significant increase in credit risk, you will not consider it again, because it cannot be worse than what it is. It has deteriorated to the extreme condition, and that's why it was not considered as one of the facilities that deteriorated, because it can't deteriorate further. Oh, how do I get 21.6? If you add all the yellow boxes together, which are the ones that we consider that have deteriorated, If you add all of them together, it will give you 10,800. 10,800. So if you do 10,800 divided by 50,000, that will give you 21.6. That's how we got the 21.6. Okay, let's go to the second way people do. Second thing that we do. Second method is benchmarking. Because especially in Africa, there are a lot of limited data. You know, abroad, everybody is rated. In Europe, everybody is rated. But in Africa, not everybody is rated. In fact, in Europe, you just easily assess people's rating. Individual, corporate, their rating is all over the place. So there is no problem about getting the rating. But in Nigeria, we still have constraint in terms of rating because not a lot of people are rating. We don't have enough data. So sometimes when we want to build this model for IFRS calculations, what we do is that we'll do what we call benchmarking. And benchmarking means that we will go and compare it to some published probability of default by a reputable organization, S&P, Standard & Poor, Moody. They publish rating grade for all sorts of instruments, and we look at our instrument and benchmark, compare it and say, okay, this my instrument is similar to S&P instrument. It's never perfect, but sometimes when you don't have information, we are constrained to make use of that. So we'll compare this instrument and say, okay, this instrument here is similar to what we have in S&P. So their probability of default should be similar. So we'll use the S&P probability of default. I mean, if you want to, rating benchmarking is another complex subject on its own because there are all sorts of school of thought on how to do rating benchmarking. So if you do that, whatever probability of default you're able to get, you will use that to calculate probability of default for your instrument. And this is a good example. In fact, we use this, I have a client that will do this for, and if you look at his investment grade, there are some instruments we just benchmark them as investment grade. See, this data is an S&P data. So we just pick whatever S&P recommend for investment grade and use it for our own probability of default. Really, one of the things that possibly could happen, some of the people that are collating rating information in the market, I know we have some rating organizations. Really, if they take this or if they understand it, they can build model around it and come up with parameters that people can use for their probability of default calculation. Although they will consider the marketability because it's a figure. And what may happen is that immediately one person buy it and he knows the figure, he will just share it with all his friends. But they have data because people will now have a credit bureau today, and people are putting in their the customer credit evaluation into that. So they have some level of data which you can use to produce this. S&P does, and we buy it from them. We buy it from S&P to be able to use it for some of the calculation, or we look for old version to use. But if we want the latest data, S&P sells it. So that's benchmarking. Then the last option is that you can combine the two. I like the option of combining the two. If a client has some internal data, I will do the internal probability of default calculation and then do an average of that and S&P, all geared towards removing as much as possible data biasness from our data. That's what we're trying to remove, so that if we are internal data is biased, you can use this external data to modify it. Now, the fourth point, which is another very important, is the economic forecasting. You know, the one we have done is based on historical. If you have followed this class, you will know that we have done it based on historical. But the probability of default you want is the probability of default for the future. So if you are doing probability of default as at December 2024, you have calculated it based on your historical data, 2023, 2024 data, that this was my probability of default because I saw what actually happened to the instrument, to the loans, for example. So I need to be able to predict what is going to be for year 2025 so that I can estimate the impairment that I should be expecting for year 2025. So for you to be able to do that, you need to do what called economic forecasting, predicting the future. And in doing that, this is where the model is built. You have done your historical probability of default, right? For 4 years. Let's say you did for 2020, 2019, 20, 21, 22, 23, 24. You have done for 6 years. You then need to determine the economic parameters that are relevant to your business. The economic parameters that are relevant to your business. Maybe you think that your business, not economic parameters that are relevant to your probability of default. What economic parameters do you think influences your probability of default? Is it an employment rate? Is it a GDP growth rate? Is it inflation? Is it exchange rate? You will determine it. And how do you determine it? For those of us that were students of economics, when you look at those various 6 years, you put your probability of default, you put those economic parameters by the side, and then do some correlation analysis. You'll be able to identify the variables that correlate with your probability of default, the economic variables that correlate with your with your probability of default. You'll be able to identify that microeconomic variables that correlate very well. Those macroeconomic variables that correlate to your probability of default, it is what you are going to use to predict what your future probability of default is going to be. So if you put let's use inflation. You've established that inflation correlates with your probability of default. You put in your inflation, you put in the probability of default for the various year. You will be able to establish a correlation formula between them. Immediately you establish that correlation formula between the data in the last 6 years, anytime you slot in a probability of default, it will give you, anytime you slot in an economic variable, a macroeconomic variable, it will give you what the probability of default will be, because the probability of default is your dependent variable. So for you to know what your expected credit loss will be for year 2025, all you would then need is to say, what is the expected inflation for year 2025? Immediately you know the expected inflation for year 2025, you put into that model, it will predict what the probability of default will be for year 2025. The same thing, if somebody gives you the inflation projection for year 2026, you can then predict what the probability of default will be. And that's how we determine the probability of default that we use to calculate our impairment. In our financial statement for year 2025, because when you are preparing 2024 financial statement, the impairment you are recognizing is the impairment you expect for year 2025 and the future, not the one that has happened. It's the expectation that you are recognizing it. I hope we're able to follow. And I know this one this can be a bit complex. Let me go. I think I'm already becoming more specific. The loss given default is how much you expect you may lose in case the customer default. So that's the obligation you expected to use. The customer is expected to lose. We do use collateral when evaluating that. So over time, they also collect data, and you'll have been able to predict what is the extent of the expected loss in case the customer goes into default. To do your loss given default determination, there's foundational approach where you use a Basel recommended LGD. Basel has a recommended loss given default of 42 or 45% now. I remember offhand. Or you can use your internal based model where you build it based on data. Simple data is customer loan written off or asset written off over a period of time, over the loan at the point of default. If you have been tracking what happened to your customers or your assets that went into default, what do you eventually lose? That's what the loss given default is trying to be able to predict that, okay, when we even have this portfolio, in case they go into default, probability of default, what do we think we will lose? So you can estimate that as customer loans balance write-off over customer loan balance at default. It's a data-driven work that you can do. So I've dealt with stage 1 and stage 2. I know how it looks like people are not here, but let me just quickly deal with this and move forward. I know this class, even when we're teaching, when I do this in the classroom, it's usually a tough one It's mathematical. You need some calculations. It's not just straightforward. So for impairment on non-performing loan, what you are expected to do, what the standard expects us to do is that the impairment to recognize is equals to the carrying amount, whatever you have in your book, minus recoverable amount, where the recoverable amount is present value of estimated future cash flow. So you determine how much cash flow you will get in respect of that instrument, and present value it, you discount it. You understand? You discount it. Whatever value you think you will get is discounted to today's value, and that will be your recoverable amount. A simple thing that you can do is just do expected contractual cash flow, whatever is the contract, times your recovery rate. If you know the rate you normally recover, which can be given as 1 minus your loss given default, what you will lose. Whatever that gives you expected cash flow, plus fair value. If you have collateral, you can add the value of the collateral times collateral recovery rate, because you also not get your collateral in full. You always lose a portion of it. That will give you expected cash flow, and you can do the present value of it. Regular back testing is encouraged. One of the things that the standard expects is that when you build all of this model, based on what I said when we're talking about the economic forecasting, you forecasted your expected impairment for year 2025. By the time you get to the end of year 2025, you are expected to do back testing, meaning that you are not going to evaluate your actual impairment based on the earlier calculation we did and say, so this was the actual impairment we suffered compared to what we predicted. How close are we? If we're far apart, it means that there is still further need to recalibrate our model. And that's how you continue to look at it, fine-tune your model, and it's expected as you do this over years, the model will become standardized. I know there will be plenty of questions, and I'm not sure if I think I've lost a couple of people. Yes, that's a financial instrument class for people that have it. It comes deep. It's always very deep. I've tried to make it not to be very deep because I didn't do amortized cost. I didn't do serious impairment calculation. I've only brought a simple model. But I mean, some of us get to do this for bigger time organization, and you see the level of data and work that goes in. But at least that's the tip of the iceberg. So we can move to presentation, which is quick. So when we go to IAS 32 financial instrument presentation, it talks about how you present your financial statement, your financial instrument in the financial statement. Part of what you are required is that at the initial point of recognition, you need to classify all your financial instruments into financial assets, financial liability, or equity. If the financial instrument contains both a liability and equity element, the component parts should be classified separately. If you have a complex financial instrument that has both a liability and equity embedded in it, you need to separate it. Common one are conversion options. Some of us will see your client's instrument and they tell you that, okay, we'll give you this money after a period of so you can convert it to shares. Or after a so period, if so conditions are not met, you can redeem it. These are instruments that sometimes I will not make a general estimate, but sometimes it could have both a liability and equity embedded in it, and you may need to separate it at the point of recognition. Liability, obligation to deliver cash or another instrument. When you have redeemable preference shares, that should always be classified as liability. And I'm happy that things have improved in the market. People no longer classify preference shares as part of share capital. Of old, people used to do that, but I have not seen that in a very long time because it's not allowed under IFRS. It's when we're doing Nigerian standard that we used to do those things. In fact, I think people don't issue preference shares again. People used to issue those preference shares those days to just meet up with the capital requirement and still have the option of running away if it's not going the way they want it. But IFRS doesn't allow that. Any redeemable instrument is a liability. The same way deposits for shares is a liability. I still see people putting deposits for shares as part of share capital. That's wrong. It's a liability. Well, this is just a lighter note. Treasury shares. If a company buys its own shares, it's treated as treasury shares. And that means that whatever is the value of the shares that he has bought, whatever is the cost, acquisition cost of the shares, his own shares that he has bought, even while it's not allowed by CAMA, it's actually not allowed by CAMA. But we've seen people do that in the past. Such things needs to be debited to your equity. So the entry technically will be credit your bank and debit your reserves as a debit to reduce the value of your reserve. But people don't really do treasury shares again. I think it has gone out of fashion with IFRS knowledge here and there. People know that it doesn't pay. So people are desisting from doing it. Okay. Part of what needs to be disclosed, any interest, dividend, losses or gains relating to your financial instrument needs to be disclosed on the face of the financial statement. If you earn income from your financial instruments, you need to disclose it. If you receive dividend, that needs to also be disclosed. When do you offset financial instruments? You can only offset your financial asset and financial liability when you have a legal right to do that. When there is a legal right to offset them, then you can do that. Or when you intend to settle it on a net basis, that time you can also offset. If there is no legal right or you intend to settle it on a net basis, then please don't offset. I spoke about this on day one, so I will just go. Questions? None. Let's go to, sorry, I'm trying to catch up. Financial instrument, let's go to the last one. I think I'll possibly stop at financial instrument and take fair value next Saturday. Financial instrument disclosure. What kind of disclosure must you make in respect of your financial instrument? One, you need to make disclosure about the significance of the financial instrument. I mean, the objective and scope is this standard helps us to disclose adequate information of to be able to assess significance of financial instrument in terms of the financial performance and position of the entity. How much impact does the financial instrument have on that business? It helps us. And then the nature and extent of risk that you are exposed to as a result of this financial instrument is also helps us to be able to understand it. Because think about a bank. A bank is 85% financial instruments. A bank is 85% financial instrument, if not 90%. So you will find that they need to make enough disclosure, people to understand it. And that's why when you see those bank financial statements, it's bulky. It's because of this financial instrument. They write a lot of story. Even while I know that a lot of people don't even read it. Even with some of us that are chartered accountants, we don't even want to read it. We just look at the number and say this story is for the auditors. But they have a lot of meanings. A lot of sense we can make out of it if we pay attention to them. So what kind of instrument? I mean, this standard is so important, disclosure that is on its own. And things that I expect us to make detailed disclosure of the carrying amount and balances for the financial instrument in the financial statement. All your various classes of financial instrument, you need to disclose the carrying amount in the financial statement. One by one, you need to disclose the carrying amount of those financial instruments in the financial statement. Two, you need to do analysis of the fair value of those financial instruments. And a lot of us, I see a lot of people, especially small, medium-sized organizations, don't comply with this disclosure. Not even in terms of volume, but in terms of disclosing it. A GT bank may use 100 pages because they have a lot of stories. But even while you are small, as far as you are exposed to this risk, you need to disclose them. It might not come with a lot of story because you will not have a very complex processes for managing it. Your process will be very basic. But we are to disclose the details and the analysis of the fair value for each class of asset. Then we are to disclose information on the nature and extent of risk arising from the financial instrument. What kind of risk are you exposed to because you have this financial instrument? And then Details on the concentration exposure. What kind of concentration risk do you have? Maximum credit risk exposure. What is your maximum credit risk exposure? This is important. Maybe because we don't see a lot of it in Nigeria. You know, in Europe, for example, when you give credits, there are some clauses they put there such that the bank cannot turn their back on you in some instances. I give you, for example, you are doing a large project, which you see happening. Somebody is building a high-rise building, and the bank is financing 40%. He has put in 60% capital. Then somewhere down the line, before he gets the project completed, the bank say they are not continuing, and they back out. What do? That whole project is at risk, because if he's not able to get alternative financing, he might not be able to get it completed. What people do is that even while you will disburse the money to me in tranches, I will make it irrevocable for you to say you are not financing this project to the end, even if I don't perform. Because if you back out, my project has failed. So I make it tough for you to say you are not completing the project. Because if you back out, I fail. Imagine Dangote, for example, $20 billion, he has spent $15 billion, and the bank said they are not continuing. Then the whole project failed. So you will have gotten them into a bond that a commitment that they will finance the project to the end, so that his own capital is also secure. Because if they turn their back, they lose their capital, I also lose my capital. So the standard expects us to disclose the maximum credit exposure, even when we have not disbursed the money. What is the maximum you can get? What is your maximum risk, even when you have not disbursed such money, because you have an obligation to must fulfill, irrespective of what happened. Then the credit quality of the portfolio. We are to disclose the quality of our portfolio in terms of maybe the credit assessment, the aging analysis, the market risk and maturity analysis. All of this needs to be disclosed. Okay. Information on the collateral head. If you are holding collateral for those financial instruments, if somebody has given you collateral for your financial asset, you need to disclose it, in fact, in the financial statement. Allowances for credit losses, default and breaches that happen, net gain or loss on those financial assets, interest income and interest expense, fee income and exposure, and expenses. All of this has to be disclosed on the face of the financial statement at the note level minimum, so that user of the financial statement can know how much interest you earn or pay, how much fee you earn or expense in respect of those financial instruments. We are to disclose the fair value, and a lot of people don't disclose the fair value. Part of what is required of the standard is that we should disclose the fair value of all our financial assets, financial instruments, whether it's measured at amortized cost or at fair value. You're supposed to disclose the fair value of such instrument in the financial statement. That's supposed to be disclosed. Then I don't see a couple of people, especially medium businesses, as small and medium entities, don't disclose this. You have to state the fair value of the financial instrument in the financial statement. We are supposed to make disclosure on each of these risks and on the following risks, on how they arise and how we manage it. What is your objective? What is your policy? And what is process for managing the risk, and the measure you use to manage them? And also make some quantitative disclosure. One, credit risk. What is your credit risk exposure? How do you get to have credit risk exposure? What is the maximum amount? How do you manage it? What kind of process do you have in place to ensure that the credit risk is within the limit? And when you also have financial instruments, financial assets that are impaired, you need to disclose it. In fact, you need to disclose your financial instrument, financial assets, analyze into the various stages based on stage 1, stage 2, stage 3 of your various financial assets. That needs to be disclosed. Liquidity. We are supposed to disclose the liquidity maturity of all our obligations, our financial liabilities that shows the remaining contractual obligation. We will group all our liability into their contractual obligation when they are due to be paid. The standard requires that we do the maturity, the liquidity maturity obligation for financial liability. But it has become a common practice, especially for financial services industry, that people now do for both asset and liability so that you can see the liquidity gap. For market risk is in threefold: currency risk, interest rate risk, and other price risk. So we are to disclose the currency risk that our entity is exposed to. If there is a change in naira to dollar rate today, how does it affect that your business? How does it affect your financial statement? That's supposed to be disclosed in the financial statement with some simulation, table and analysis to show how it will affect you. It's not just in writing, it's also that you will do some currency risk quantification, and that's part of my, those things excite me, doing some of those risk quantification. So you're supposed to quantify your currency risk, how it will affect you. The same thing, your interest rate risk. If there is a change in your interest rate today, how will it affect that your business? That's supposed to be quantified in the financial statement and disclosed. And same thing with your other price risk. If you are a company that trade on equity, for example, how does the volatility in the market affect your business? You are expected to disclose it in the financial statement for the user of financial statement to understand it. And I'm sure if people have been disclosing it and people been doing this analysis thoroughly, a lot of people will have had an expectation or could have predicted how the devaluation in the Nigerian market will have affected them. And this is one thing that banks do. Commercial banks take their time to do it. And that's why you see that most time they don't get it because they are already analyzing it and studying it. Yes, because that's their core business. So they don't take chance on it. Because if you take chance, imagine they take chance, that time we had the exchange devaluation in Nigeria. They could have, some of them would have been wiped off. But rather, instead of it affecting them, it was in their favor. They deliberately positioned for it because they finalized it and said this is the way it will go. So they make sure their instrument is in their favor. And they take time to analyze it. So you are expected to do the sensitivity analysis on all of these risks. How will it affect you if the interest rate changes, if the exchange rate changes? And that's what this expects us to do and disclose it in the financial statements. Question. Let me go to the chat box. And I think I will not take the live standard for today. We'll possibly take it next. We'll take it next Saturday. Fair value measurement is related to this, but time is fast spent. So I will just keep it. But I will take questions for the remaining few minutes. We always like to keep this within the set time. Okay, Bishop said, kindly share with us all the slides so that we can use it as reference point when reading or watching the video. Well, what we'll do is I will push the video out. We are not pushing out the slide, but the video has all the slides because I'm going through the slide one by one. So you can always go back to video and watch it. What about if it is with recourse? This is what most banks do. If this is sales with recourse, if I get you with recourse, can be sales with recourse. You can be sales with recourse. If you have sales with recourse, in fact, your first issue in sales with recourse is determining whether you should recognize that instrument. Like if you have a buyback instrument, do you recognize it or not? Those are the first critical thing. Immediately you conclude, and unfortunately we don't have anything on the recognition and synchronization of financial instrument. There's a whole lot of things that this standard deals with, also on the recognition of financial instrument, and in that place where we cover things like synchronization of instrument. So if it's a sales with recourse, depending on the term, you may not even recognize it in your books. And once you don't recognize it as your asset, you need to calculate impairment for that. And I believe I've answered the question. I don't know if we have any other question. If you have any other question or concern, I can take it. You can just indicate, raise your hand. I will take your comment or concern before we call it a day. It's 10 minutes to end of the class. Okay, it appears we don't have any concern or comments for the day. So it will be good to thank everybody that's joined the class today. Finally, okay, before we go, we'll have somebody raising his hand. We do appreciate all your comments. I'm trying to, okay, I've seen, let me start with Mohammed Obashola. Mohammed, please unmute yourself. You can unmute yourself, Mohammed.
Confirm if you can hear me. Hello, can you hear me?
I can hear you. Please go ahead.
All right. Good evening, everyone, and thanks very much PMA Professional Service. I must really commend you guys' effort for bringing this to my doorstep. I'm really grateful for that. But I would appreciate it more if this particular slide could be shared with us after the session. Thanks very much, Mr. Biola, and I look forward to hearing your opinion on my request. Thank you.
Okay. Thank you, Mohammed. I need to ask my team on this because we don't release our slide, we release our video because that's our intellectual property. You understand? And I'm sure you know that people will do this kind of thing for a fee, but we just it's part of what we do some of these free things. And so it's asking for a lot really from us. I know what it is, but it's asking a lot. But I will consult internally. Like, I'm open about it. I will consult internally within the firm. Okay. All right. So thank you everybody for this, and wishing us a very good Saturday evening. And it's been a lot of sacrifice, but that's what makes a very good learning. And I would leave this with us. IFRS is not learned in one day. It's a marathon. Just continue learning, and I can tell you, you will become an expert. And every day we're all still learning. I am still learning. So you too can continue to learn. Thank you very much, and have a very good evening.